Okay, let's unpack this. You're looking to understand what's really going on at Starbucks right now, their big moves, maybe without digging through dense financial reports yourself.
Yeah, consider this your shortcut.
Perfect.
Today, we're doing a deep dive into Starbucks' Q2 results for their fiscal year 2025.
Right, fiscal 25 Q2.
And the goal here is simple. Pull out the most important insights. We've got their official earnings release, the analyst call.
All the key sources.
Exactly. We want to give you a really clear, concise picture of where they stand now and where they're headed.
So we'll hit the key numbers, dig into this back to Starbucks strategy everyone's talking about.
Yep, and see what progress they're claiming, what the leadership's actually saying about the future.
And keep it engaging, right? No drowning in data, just the need to know stuff.
That's the plan. So should we start with the big picture, the overall financials for the quarter?
Let's do it. What did the top line look like?
Well, consolidated net revenues,
Okay.
they saw a small increase, up 2% to $8.8 billion.
Okay, 2%. Not massive growth.
No. Though if you adjust for currency fluctuations, it was slightly better, around 3% growth.
Gotcha. But how did the stores themselves perform, the comparable sales?
Ah, that's where it gets interesting. Global comparable store sales actually went down by 1%.
Down 1% globally. What drove that?
It was driven mostly by fewer people coming through the door or fewer transactions. Comparable transactions were down 2%,
Okay, fewer visits.
but this was partly offset because the average amount people spent per visit, the average ticket that went up by 1%.
So fewer people are visiting, but they're spending a bit more when they do.
Seems like it. Could be price increases, could be people buying more items.
Hmm.
It suggests a potential shift, something to watch.
Definitely. Could impact loyalty down the line if visits keep dropping. What about the bottom line, profitability?
Yeah, that took a pretty big hit this quarter. Their standard profitability measure GAAP EPS that decreased by 50% landed at 0.34 cents.
Wow, 50%. That's substantial.
It is. And the non-GAAP EPS, which adjusts for certain items, that was also down quite a bit, 40% to $30.41, or 38% on a constant currency basis.
So big drops in earnings per share, however you slice it. And operating margins, did they follow suit?
They did. Significant contraction there. The GAAP operating margin shrank quite a lot, down to 6.9%.
Ooh.
And the non-GAAP operating margin also contracted down to 8.2%. So profitability was definitely squeezed.
Right. But despite those pressures, they kept opening new stores.
Oh yeah, expansion continues. They opened 213 net new stores in Q2.
Bringing the total to...
A huge number, 40,789 stores globally now.
Wow.
And the U.S. and China, they still dominate the portfolio, making up about 61% of all those stores.
Okay, so that's the global overview. Let's break it down by region. North America, how did things look there?
Pretty similar trend to the global picture, actually. Comparable store sales in North America were down 1%.
And was that also driven by fewer transactions?
Yes, exactly. Transactions down 4%, but again, partially offset by a higher average ticket, which is up 3% in North America.
And the U.S. specifically, sometimes that differs.
The U.S. decline was a bit steeper on the comparable sales front, down 2%.
Same drivers, though. Fewer transactions, higher ticket.
Same story. Down 4% on transactions, up 3% on ticket in the U.S., and profitability took a big hit in North America, too. Operating income down 35%.
Ouch. And the margin?
Contracted down to 11.6%. So definitely feeling the pressure stateside and in Canada.
Although, didn't they still add stores in North America?
They did. Over the past year, they had 5% net growth in company-operated stores in North America.
So that store growth helped cushion the revenue blow from the falling comparable sales, I guess.
Exactly. Partially offset. And interestingly, the CEO, Brian Niccol, he did mention seeing some early indicators of recovery, specifically in North America.
Oh, really? What kind of indicators, given those numbers, that sounds optimistic?
Well, he pointed to things like better partner engagement, employee engagement, lower turnover rates among staff.
Okay, that's important for service.
And he said the rate of transaction decline was starting to slow down. So maybe the bleeding is lessening, but it's still early days.
Definitely something to watch next quarter. Did Canada buck the trend at all?
Actually, yeah. Canada showed positive comparable sales and positive transaction growth.
What was working there?
They credited food innovation, apparently. New food offerings driving traffic.
Interesting. Okay, let's hop across the pond. The international segment.
International looked a bit stronger on the comp sales front. Comparable store sales were up 2%.
Okay, driven by more visits.
Yep, transactions up 3%. But the average ticket actually dipped slightly, down 1% internationally.
So more people coming in but spending slightly less per visit on average.
Pretty much. But profitability also decreased internationally. Operating income down 7%, and the margin contracted to 11.6%, same as North America, actually.
But overall revenue is up internationally.
Yes, revenue increased by 6% in the international segment.
What drove that revenue growth then if comps were only up 2% and margins were down?
Well, mostly store growth. An 8% net increase in company-operated stores internationally, plus growth in their licensed store business.
Right, the footprint expansion. Now, the big one internationally, China. How did they fare?
China's comparable store sales were flat, 0% change.
Flat. How did the transactions versus ticket play out there?
It was a perfect offset. Transactions were up 4%,
Okay, positive sign.
but average ticket was down 4%.
Mm-hmm.
So they completely canceled each other out for a flat comp.
Got it. Did they say anything else about China?
Nicole mentioned they're seeing improved customer and partner engagement levels in China. And they also noted that 8 out of their top 10 international markets actually got back to flat or positive comps. So some pockets of strength.
Okay. One more segment, channel development. That's the coffee sold in grocery stores, ready-to-drink stuff.
Exactly. That segment saw its net revenues decline by 2%,
Why the decline there?
primarily due to a drop in their Global Coffee Alliance business, although their ready-to-drink products did see some growth.
And profitability.
Also down, operating income fell 11%, and the margin contracted there too.
Okay, so definitely a mixed bag across the board. Some challenges, especially in North America and on the profit lines, but still expanding the store base.
A very mixed picture, yes. Which brings us neatly to what they're doing about it, this back to Starbucks strategy.
Right. How are they framing this? What's the core idea?
They're calling it a customer-centric turnaround plan. It's built around 4 key pillars.
4 pillars, what are they?
Partners, their employees, the coffee house, the physical space, the customer experience, especially during busy times.
Yeah.
And finally, marketing and menu.
Okay, let's take those one by one, starting with partners. What are they doing for their employees?
A big thing they highlighted was launching an updated Shift marketplace. It's a tech tool for partners.
What does it do?
It basically makes it way easier for them to manage schedules, pick up extra shifts, swap shifts within their district, more flexibility.
And is it working?
They reported a huge increase tenfold in partners available for short-notice shifts, and they filled 500,000 more shifts compared to last year. Record numbers.
Wow. So better staffing, presumably.
That's the idea. More consistent staffing, better able to handle those peak rushes, capture more sales. They said it improves both the partner and the customer experience.
Makes sense.
And they also mentioned record low turnover and higher average tenure for partners. So it seems to be helping keep staff happier and longer.
Any other partner initiatives?
They're holding a big leadership conference for their North America store managers in June, aiming to further support them.
Okay, pillar 2, coffee house. Improving the actual store environment.
Exactly. They're focusing on maybe smaller things, but things that impact the feel, like baristas writing notes on cups.
Oh, bringing that personalization back.
Yeah, bringing back ceramic mugs for here customers, expanding free refills, making sure seating is comfortable and inviting.
Trying to recapture that third place vibe.
Totally. They said customer feedback is positive, and they're seeing more sit-and-stay behavior, people lingering longer.
Are they changing store designs too?
Yes. They're evolving their design standards for a more welcoming feel. Rework stores are starting to open in places like NYC and Southern California.
And they're looking at the existing stores.
They are, evaluating the current portfolio, but also focusing on a stronger pipeline for new stores, making sure they're in the right growth markets with better potential profitability.
Okay, pillar 3, customer experience. They call this winning the peaks, right? Focusing on busy times.
Exactly. And the shift here is interesting. They're moving focus from just pure speed of production towards the craft of the drinks and making those customer connections.
So less about just churning drinks out faster.
Kind of.
Yeah.
They said they learned that investing in labor, having the right number of well-trained staff in the right places, does more for throughput and bringing customers back than just throwing more equipment at the problem.
That's a significant insight. Did they test that?
Yeah, they ran a pilot in 700 stores focusing on staffing and deployment. They said it improves speed and customer connection scores.
And technology still plays a role.
Oh, for sure. They tested a new order sequencing algorithm. The idea is to cut wait times in the cafe and drive through without messing up mobile order times.
Did it work in the test?
Apparently, yes. They saw average cafe wait times drop by about 2 minutes at peak, with 75% of cafe orders ready in under 4 minutes in those test stores.
That's a noticeable difference. Are they
Absolutely.
rolling this out wider?
They are. Starting in May, they're scaling up what they call the Green Apron service model. It combines new service standards, different partner roles, streamlined routines, and that sequencing algorithm,
How many stores?
aiming for over 2,000 U.S. company stores by the end of this fiscal year.
And the expected benefits.
They're hoping for more flexibility, better peak throughput, capturing more demand, a more premium feel, and ultimately getting transaction growth moving in the right direction again.
Interesting that the focus is shifting more to labor strategy over big equipment rollouts.
Yeah, they explicitly mentioned pausing the rollout of some capital-heavy stuff like the Siren cold beverage and food equipment.
And they're not doing the cold press brew equipment they talked about before?
Nope, decided against moving forward with that.
Yeah.
It really seems like a pivot towards optimizing the human element.
Though they are still rolling out some tech.
Yes, the Clover Vertica brewers are still going in about 70% complete in U.S. company stores now. And they mentioned an upcoming app update, too.
What's new in the app?
Scheduled mobile order pickup is coming, plus better price transparency in the app.
Okay, that covers the experience. Final pillar, marketing and menu. Calling it reintroducing the Starbucks experience. What's happening there?
Well, they launched a new U.S. brand campaign in Q2, and they highlighted a specific promotion, Starbucks Monday.
What was that?
Offered free brewed coffee after some major sports events. They said it drove record engagement and their second highest Monday sales ever.
So promotions are still key. Are they seeing shifts in brand perception?
They claim they are. More customers ranking Starbucks as their first choice, apparently, and more buzz on social media like TikTok.
And the menu itself, any big changes?
They're continuing to simplify or rationalize the menu, trying to focus more on core coffee and craft.
Making space for new things.
Exactly, and allowing for better execution. One example they gave was reformulating their matcha, removing added sugar.
Did that work?
Sales jumped 40% for matcha after that change, they said. They also launched a new Cortado platform, using those Clover Vertica brewers for premium coffee options.
Any teasers for what's coming soon?
Yep, summer menu is on its way. Summerberry refreshers with pearls are coming back.
Pocket ones.
A new limited-time iced horchata oat milk shaken espresso, and some new Frappuccino stuff, too.
Sounds summery and longer-term innovation.
They talked about a more agile test-and-learn approach, focusing on enduring platforms, not just one-off LTOs. Culturally relevant innovation.
In drinks and food.
Yes. On the food side, they're exploring more artisanal options, like freshly baked or assembled items, getting ideas from international markets like the UK.
What else are they exploring?
Things like a health and wellness platform, new drinks to attract people to craft coffee, maybe an aperitivo menu for afternoons,
Aperitivo, interesting, like cocktails.
or maybe mocktails, snacks, aiming for that afternoon day part, and also more regular limited-time flavor launches inspired by baristas and customers.
Lots of ideas bubbling up. Are they using tech to support menu changes?
Yeah, the digital menu boards rollout continues. Over 25% of U.S. company stores have them now.
What's the benefit there?
More flexibility. They can change the menu features by time of day, introduce new items more easily, do more targeted marketing right there in the store.
Okay, that's a pretty comprehensive plan across all four pillars.
Yeah.
What about outside the U.S. international strategy?
They really emphasize that Starbucks is a global brand, but the business is executed locally. The Back to Starbucks plan is meant to support resilience everywhere.
Are they sharing learnings across markets?
Yes, using insights from international to inform their global test and scale approach. And they're adapting that U.S. brand campaign for key international markets, too.
And the specific approach for China? Still committed long-term.
Very much so. Reaffirmed long-term commitment. They highlighted some early positive signs from changes they've already made there, like more sugar-free drinks, different price points, and they have a China-specific version of the Back to Starbucks plan.
Got it. Let's talk financials again, but looking forward. Financial discipline and outlook.
A big focus on managing costs and improving the fundamentals. They stress that the labor investments are strategic and critical for the customer connection.
Not just adding cost.
Right. But they're also working on optimizing workflow and simplifying the menu to help offset that. G&A expenses were down, partly due to lapping prior costs and some restructuring savings.
Any more restructuring coming?
They hinted there might be some more costs near term, but they expect them to be finite, not an ongoing thing.
And how are they thinking about using their cash? Capital allocation?
Sticking to their strategy. Invest for high returns, keep a strong balance sheet, and return cash to shareholders via dividends.
Did they give any specific guidance for Q3 or the rest of the year?
The new CFO, Kathy Smith, basically said it was too early premature to give a formal outlook, but she did suggest Q3 top line should follow normal seasonality. So maybe some sequential improvement from Q2, but no firm numbers yet.
What about external risks? Tariffs, coffee prices.
On tariffs, they said they have a team actively managing it, strengthening the supply chain, sourcing locally where possible, moving production if needed, mitigating the risk.
And coffee bean prices. They've been volatile.
They acknowledge the volatility but feel their procurement team has done a good job securing favorable pricing through purchasing and hedging. And they put it in perspective. Green coffee is typically only 10–15% of their product and distribution costs.
So important, but maybe not the biggest cost driver people assume.
Right. And importantly, they stated very clearly, no plans to increase prices for the rest of fiscal 2025.
Holding the line on prices for now. Okay.
That's a significant commitment given the inflationary environment.
Definitely. So let's try to wrap this up. Key takeaways.
Well, Starbucks is clearly in a major realignment phase with this Back to Starbucks plan. The current financials, especially profitability, show the strain and the investment required for this turnaround.
But leadership seems confident.
They express confidence, yeah, especially in the early progress they're seeing, particularly around improving the experience for both customers and partners. Fixing the foundation, essentially.
And the biggest shift in approach seems to be.
For me, it's that renewed focus on labor, on the partners, and really trying to bring back that third place feeling. It's less about pure automation, more about the human touch, it seems.
And it's not going to happen overnight.
No, definitely not. The emphasis on testing and scaling suggests the full financial impact is still a ways off. It'll take time to see if this translates into sustained growth.
Which leads to the final thought for you, the listener. Think about this. How might this big bet on the in-store experience and employee engagement reshape the whole coffee shop landscape?
Yeah, and will these investments, which are clearly significant, actually pay off in terms of profitable growth in what's still a really dynamic, competitive market? It's definitely one to keep watching as this strategy unfolds.